Hi, Chris Goki here. I am the creator of Candlestick Charting, which is a technical analysis app on the App Store and supports both iPhone and iPad devices. So I have a question. Have you ever looked at a chart and said to yourself, looks like we might have hit bottom. So what do? You buy in, and then the next day it takes a turn for the worse and just keeps dropping. Well, you are not alone. Trading is hard. The study of trends and being able to predict the likelihood of an actual reversal, to me, is one of the most interesting aspects of technical analysis. All right, so today's topic is going to be on Wells Wilder's work on directional movement. His work on being able to bring different technicals together and actually reduce the concept to a mathematical equation is brilliant in how he goes about it. Now, I won't go into the math of it, but instead focus on how to use the technicals themselves. All right, so I'm going to zoom out here, and then I'm going to scroll sort of back to the current day. You can see this particular stock, Blucora, has had a great uptrend lately. But what I wanted to talk about is two technicals. The first is plus DI14, and then the second is minus DI14. And what these two technicals stand for is plus directional index 14 and minus directional index 14. And what they represent is plus DI14 represents the percent of true range of the last 14 days, which was up. So if you look down here in the app itself, you can actually see these numbers for the current day. So today, for the plus DI, the value is 31.75, and then the up arrow means it's moving up. And then the minus DI is 5.17, and that's moving down. So what this says is 31.75% of the true range for the last 14 days has been moving up, and 5.17% of true range of the last 14 days has been moving down. All right, so here's the breakthrough that Wilder made. True directional movement is the difference between plus DI14 and minus DI14. The more directional a stock is, the greater the difference between plus DI and minus DI. If a stock moved up, for example, for 14 days in a row, plus DI would have a large value and minus DI would approach zero. Conversely, if the stock moved down for 14 days in a row, minus DI would have a large value and plus DI would approach zero. Now, if the stock cools off and the price meanders, then the difference between plus DI and minus DI would be very small and non-directional. So you can kind of see that here. This is today's value plotted here in this ADX. The green represents the plus DI. The red represents the minus DI. And you can see the difference between the two. The red is approaching zero because the stock has been moving up, and the green is a much larger value, and there's a fairly significant difference between the two. All right, so what Wilder does is he builds a new indicator called ADX, which basically uses these numbers, plus DI14 and minus DI14, and does some smoothing to come up with this ADX value. Now, a low ADX value means that the stock is non-directional, whereas a high ADX value means that the stock is trending strong. And so the ADX is actually represented by this black line here. And given this stock is at a strong downtrend and then also a strong uptrend, you can see the majority of these values are above 25. And 25 really is the key value there for ADX, which indicates a strong trend. So think about a stock where the stock goes straight down for a number of days and then turns around and goes straight back up. Now, the ADX, if we come back to here, the ADX will increase given minus DI is increasing, so minus DI is increasing. Then once it reaches the top and turns around, because plus DI will increase, this will cause the ADX value to get smaller and smaller, then larger and larger as minus DI gets further away from plus DI. So as you can guess, this actually provides a nice crossover technical. If plus DI, which is here, crosses over minus DI, which is here, you go long. Conversely, if minus DI crosses over plus DI, you go short. All right, now there's one qualifier that Wilder mentions, and that is called the extreme point rule. So it goes like this. If you're long, the extreme point would be the low made on the day of crossing. And if you're short, the extreme point would be the high made on the day of crossing. So what this is used to confirm that the trend has changed and you should go long or short. So if, for example, you want to go long, the price will need to rise above the extreme point to get a confirmation. So let's take a look at this. So here we've got the plus DI crossing over the minus DI. So let's see when we should actually go long. So if I double tap on this area, we can see here is where the crossover happened. So you can see from here to here, which is between the 12th and the 13th. The high of the day is here. So in order to confirm going long, we'll have to get past the high of the day. So it didn't happen on the 14th, didn't happen on the 15th, didn't happen on the 18th, and it was the 19th is where the confirmation happened that we actually went long. All right, now let's consider a case where this can actually save us. So if we zoom out to here, kind of take a full look at this. As you can see here, we're going to go long right around in this area because the plus DI crossed over the minus DI. So we're long, we ride it all the way up to right around here. But then suddenly you notice that the minus DI crossed over the plus DI. So this wants us to go short. So let's kind of see what's happening here. So we're going to double tap into here and take a look. So you can see that it wants us to go short here because the minus DI on the 10th crossed over the plus DI. And the extreme point is here, which is the low of the day. So the confirmation of the short actually happens if subsequent prices gets below the extreme point, which is right here. Now, as you can see, the price never moves below that extreme point. In fact, it continues higher and higher and higher. So that's actually often the case when it comes to these crossovers. Often the extreme price point made on the day that the index crosses will not be penetrated again, and the market will just turn back in the direction of the open position. And if that happens, it is considered a false signal, so you definitely need to watch out for that. All right, so one last thing. The app actually does a lot of this for you, particularly the part of alerting you of these confirmations. Now, the directional indicators can actually be turned on by going to Settings and then going down here for Signals and just changing this to Directional and then pressing Apply. When you do that, you'll notice these L's show up down below, L's or S's. So this means at this particular point there is a confirmation to go long, and then you would take this run up. If you go back, you'll see a short opportunity that it predicted over here. And there's the short opportunity, which is right around here, in which you would take this and follow this down. So these are some pretty good opportunities. And also in the stock screener, you'll notice that there is a screen called CSI crossovers. And what this is these are, it filters these what's called CSI volatile stocks looking for recent plus DI, minus DI crossovers that have risen above the extreme point, the high of the day that it was crossed, and this is considered the reversal. So take a look through here as well, because there's some pretty good potential buys, I think, from this particular screen. using the technicals developed by Wilder. All right, that's it. All right, so final note. If any of this looks interesting to you and you have not already done so, I'd like to encourage you to download my app. You can download it from iTunes by typing Candlestick Charting in the search box. Your support means a lot. I have a zillion more things that I'd love to do with this app, but can only do it with the support of users like you. So enjoy and good luck in your investing.